stop scrolling for 10 seconds. Seriously, if you think investing means gluing your eyes to a multi-screen setup, obsessing over meme stocks, and sweating bullets over daily red charts, you are walking directly into a statistical trap that crushes 97% of the people who try it. There is a brutal truth that the trading apps with the colorful confetti animations won't tell you. A recent university study found that nearly 97% of day traders lose money or barely break even over the long run. Almost all of them fail. So, ask yourself this: do you want to be the person stressing out just to lose your hard-earned cash? Or do you want to learn the boring, unsexy cheat code that actually turns ordinary people into millionaires? Let's talk about the difference between gambling and wealth building. First, we have to look at the short-term trap. This is what you see in the movies, buying a stock today hoping to flip it next week for a quick profit. It looks exciting on social media, where people claim to turn $1,000 into a Lambo overnight. But short-term investing has 3 silent killers that are designed to destroy your returns. The first is competition. You aren't betting against other guys on their iPhones. You are betting against billion-dollar institutional algorithms that trade in microseconds. The second killer is taxes. If you sell a stock in less than a year, you get hit with short-term capital gains tax. That means your profit is taxed at your highest income bracket, up to 37% in the US. You take all the risk, and the government takes 1/3 of the reward. It is a losing game. Now, look at the strategy that beats the traders almost every single time: long-term investing. Long-term investors don't play the market. They own it. Historically, the S&P 500 has returned an average of about 10% per year over the last century. That doesn't mean it goes up every year. Some years it crashes and some years it soars. But if you hold for decades, the line moves up. Why does this win? Compound interest. Einstein reportedly called it the 8th wonder of the world, and here is exactly why. If you invest just $500 a month starting at age 25 and you get that average 10% return, by the time you retire at 65, you won't just have savings. You will have approximately $2.6 million. But here is the part that should blow your mind. Over those 40 years, you only actually put in about $240,000 of your own cash. The other $2.4 million came from the market working for you while you slept. That is the fundamental difference. Traders work for their money. Investors let their money work for them. The best part of this approach isn't even the money. It is your psychology. When you buy high-quality index funds with a plan to hold them for 20 years, you simply do not care what the news says today. When the market crashes, a trader panics and sells. A long-term investor sees a Black Friday sale and buys more assets for cheaper prices. You effectively become immune to anxiety. Plus, the tax code rewards patience. If you hold an asset for more than a year, you pay long-term capital gains tax, which is significantly lower than regular income tax. The system is literally rigged to help you get rich, but only if you are patient. So here is your challenge. Stop trying to time the market. You cannot predict the future, and neither can the guys on Wall Street. Instead, focus on your time in the market. Pick a boring, low-cost index fund, set up an automatic transfer every time you get paid, and delete your trading app password so you aren't tempted to peek. Being a boring investor is the most exciting thing you can do for your future self. Don't trade. Envies.